Welcome back to our channel where we bring you the latest news and updates from the world of business and finance. Today we are going to talk about the recent disaster that has hit Silicon Valley Bank, and what this means for the company and the broader technology industry. Silicon Valley Bank is a well-known name in the technology industry, providing banking services to startups, venture capitalists, and other technology companies. However, the bank has recently been hit by a major disaster that has left many wondering what the future holds for the company. As the preferred bank for the tech sector, SVB's services were in hot demand throughout the pandemic years. The initial market shock of COVID-19 in early 2020 quickly gave way to a golden period for startups and established tech companies, as consumers spent big on gadgets and digital services. Many tech companies used SVB to hold the cash they used for payroll and other business expenses, leading to an influx of deposits. The bank invested a large portion of the deposits, as banks do. The seeds of its demise were sown when it invested heavily in long-dated U.S. government bonds, including those backed by mortgages. These were, for all intents and purposes, as safe as houses. SVB didn't have enough cash on hand, and so it started selling some of its bonds at steep losses, spooking investors and customers. It took just 48 hours between the time it disclosed that it had sold the assets and its collapse. Given banks only keep a portion of their assets as cash, they are susceptible to a rush of demand from customers. While SVB problems stem from its earlier investment decisions, the run was triggered on 8 March, when it announced a $1.75 billion capital raising. It told investors it needed to plug a hole caused by the sale of its loss-making bond portfolio. Customers were now aware of the deep financial problems at SVB and started withdrawing money in masses. Unlike a retail bank that caters businesses and households, SVB clients tended to have much larger accounts. This meant the bank run was swift. 2 days after it announced it would raise capital, the $200 billion company collapsed, marking the largest bank failure in the U.S. since the global financial crisis. The government is not saving SVB. It will stay collapsed or wound up with remaining assets dispersed to creditors unless a buyer can bring it back to life. U.S. agencies extended a guarantee to cover all deposits at the bank, as well as for customers at a second smaller institution, Signature Bank, that collapsed over the weekend. Central banks around the world have been raising rates over the past year to tame high inflation, with the U.S. moving from near zero to more than 4.5% at a rapid pace. Most forecasters expect rates to go higher in the U.S., UK, and Australia, before stabilizing.
So, that's our analysis of the recent disaster at Silicon Valley Bank. We'll be keeping a close eye on this story as it develops, and we'll bring you all the latest news and updates as they happen. Thanks for watching, and we'll see you again soon.